Okay, well, thank you everyone once again for joining. All of us at Diligence Vault are especially grateful for all of you joining today and our speakers. We've got Sarah Samuels, Tim Barrett, and TJ Carlson. So without further ado, I am going to pass it off to Sarah Samuels, partner at NEPC, and she will be our moderator today. Sarah, thank you very much for joining.
Great, thank you so much. Welcome everyone. It's a pleasure to be here with all of you today, albeit remotely and virtually. So I'm really pleased to be able to spend some time today with Tim Barrett, CIO of Texas Tech University, and TJ Carlson, CIO of Texas Municipal Retirement System. There's obviously lots of topics to discuss. We have a few that we've outlined as what we believe to be front of mind today, but we also are welcoming questions. We're going to be taking questions throughout, so feel free to submit your questions through the Zoom app, and we will take those in turn. So we'll start with introductions, although many of you probably already know and are aware of Tim and TJ and their success and their roles. I am Sarah Samuels, as mentioned earlier. I am a partner at NEPC and I oversee our investment research team. I joined NEPC after spending a couple of years at Wellesley College, investing in that endowment, and before that at Mass Prim on the public pension fund side. NEPC is an investment advisor and an investment manager for over $1.1 trillion in assets, and we work with clients across different plan types, from corporate pension funds to endowments, foundations, to public funds, and more. So maybe to help set the stage, perhaps Tim and TJ, each of you could share a little bit about your organization, the size of your pool of assets, and your staff, your team size, how you're currently positioned, what's your strategic asset allocation, and how you manage that capital, whether it's internal or external.
Sure. We're about $1.2 billion in endowment assets, about another $800 million in Tier 3 operating assets, so $2 billion roughly together. We run that on a unitized basis, so we utilize various parts of endowment in the operating capital that lower risk rather than endowment. From a staffing standpoint, we have five investment people, 2 ops, and 1 office assistant. So a pretty small team. The allocation is relatively conservative for an endowment. We're at a 30% target for public equities, 20% in debt strategies, 20% what we call diversified assets, which is just uncorrelated credit, and then 30% in privates across the board, and that's real assets, diversified assets, private debt, and private equity.
Tim, I'm sorry to interrupt you. I'm having a little trouble hearing you at times. I wonder if if you connect via telephone as opposed to computer audio, if it might be better. We're just getting sort of spotty coverage of your audio.
Okay, well, I will work on doing that, and then maybe TJ can cover his.
Thank you, Tim. We'll come back to you.
Great. Thanks for having me. Let me know if you are having similar issues to Tim, or if this is going okay. We're a 30 billion public pension plan in Texas, here in Austin. We manage retirement programs for 900 cities in Texas. It's a voluntary program and basically covers any of the cities that aren't big enough to have their own system. We have 26 investment staff in the investment department, but that covers about 16 investors, 4 in risk, 3 in operations, and our admin support. One of the things that probably is important it's been very important for us in this current environment, we actually, after 6 years of efforts, we got delegated authority within certain corridors back just in February. And so it was perfect timing to give us enough flexibility to help us navigate through this. So that's been an interesting situation. Our discount rate is 6.75, so we're on the conservative end. we're 90% funded, so we're extremely well funded. 30% public equity, 10% Barclays Ag, or whatever it's called these days, 20% credit, and then 10% each to private equity, hedge funds, real estate, and then real assets. We do not do anything internally currently. We are looking at bringing the core fixed income in-house, that 10%. So we'll be talking about that with the board as we go forward. So that's kind of our background, how we're set up today.
Great, thank you. Tim, would you like to jump back in?
Yeah, I'm gonna try this one more time and speak up a little bit. I was getting a lot of echo between the two. So can you hear me better now?
It is better.
Great. Texas Tech is about $2 billion, about 1.2 in the endowment, about 800 million in what we call operating assets of the university system. We unitized part of the endowment, so the operating assets are invested jointly in various endowment components, albeit at a lower risk profile. We have roughly 8 staff members. There is 5 in the investment team, 2 in ops, and 1 operational person that oversees the office. As far as the asset allocation goes, I'll just speak to the endowment per se, but it's 30% public equities, 20% what I call public debt or credit, mostly credit hedge funds, 20% diversifying assets meant to be uncorrelated or lowly correlated with equity and credit, and 30% in privates, roughly 10, 10, and 10 across equity, debt, and diversifying / real assets. Recently, we ramped up the private equity side at the expense of the others and privates to 15% to add more risk exposure on the private equity side.
Great, thank you.
Sure.
All right, so this is obviously a unique situation, not one that we've encountered before in our lifetimes, although we have lived through other financial crises. This one's different of the COVID situation on your investment office. So how are you working from in a remote environment? How is that going? How are your investment committee meetings coming along? Have you had to consider any changes to the way your governance is set up to get things done? How has it affected the management of your university or your retirement system? Just some of those on the ground insights would be really helpful.
Sure. From our standpoint, I think the level and the number of investment committee meetings has increased through the crisis as the investment committee has been quite concerned about market impacts. So we've had more frequent meetings with the investment committee, all through Zoom, I might add. So everybody had to get accustomed to that. That's taken a little bit of effort as it's more difficult to flip around in documents. But we are getting more adept at that. In fact, we use systems called CASIA and FactSet. And some of the things that we're working on CASIA now, such as Power BI links to CASIA, we're starting to build dashboards that we can control through Zoom that have layers of data as you click on it, so that you can open up charts and look at performance of subgroups and then all the way down to the managers, and do that in a much more automated fashion. And we're finding that those type of programs are adding a lot of value in explaining things to investment committees and boards. So I think technology is continuing to play a big role for us, and it's expanding rapidly. I think we're just at the forefront of that at the tech office of starting to expand that, mainly because we were forced to because of what's going on. In regard to, oversight from the university, there's been less of that. The regents have their own issues in regard to the university opening up and managing the overall university finances. Obviously, if you think about universities across the United States, frankly, a lot of them are in trouble, right? You think of especially the big schools that have sports that drive a ton of revenue from sports. All those sports for right now are considered shut down, but you have to maintain all those teams, all those coaches, all the costs still stay. So the same cash crunches that you think of in a normal business that you might invest in, they impact a university as well. Luckily, some of the federal programs are providing some support to the universities. What we're seeing across the board is a number of endowments that are being asked to pay out higher rates to support the universities during this period. Fortunately for tech, we're about 8% of the university budget, and they have not come to us to ask for a larger spending output. We pay about $16 million a quarter to the university on our payout profile, which is 4.5% on a rolling 12-quarter basis. But they have not come to us for that. We are prepared to do that should they need it, because that's why we're here. But so far at an 8% budget total for the endowment, I don't suspect that will happen.
So, and from our standpoint, you know, when we designed our disaster recovery plan back about 8 years ago, 7, 8 years ago, we actually put in a piece there where we required all of our staff to work from home 1 day a quarter to make sure that their systems were up and running, that their softwares were up to date, that they had connectivity with the custodians or being able to wire money and have all those kinds of things that have to be done on a daily basis. So literally we got the word that we were shutting down at 3 o'clock on a Friday. And so basically everybody just grabbed what they needed and started from home on Monday and really didn't miss a beat, I think because of our planning on that. Now, given that, we did have to then, as Tim was talking about, figure out this whole audio-video communication methodology. We tried several different systems. We did Teams on Microsoft. We did Zoom. We ended up settling on the GoToMeeting solution, and that works pretty well for us. I mean, we're doing one-on-one meetings between me and an analyst, all the way up to our investment committee meetings, where we've now structured it so that all the voting members of the committee and the speakers who are presenting are in video mode and everybody else is in audio-only mode. We've learned how to control things from behind the scenes, to make sure that we have good connectivity and things like that. So that's actually been very interesting and very helpful, given this new delegation that we've had. And it's been interesting because it's been helpful. For example, when I joined TMRS, 7, 8 years ago, we were sometimes taking 12 to 15 months to get a deal done through, signed, in place, funded, and all those kinds of things. And we've been steadily improving that over time. And I was very happy that we had an opportunity during this crisis to take advantage of, but we literally had to finish it by the end of the day that we found out about it. And we were actually able to get that turned around in just 2 hours. So increasing that communication, improving the processes, getting the delegation has been very helpful for us. I guess one of the other things I think that's been very helpful for us in this, with regards to liquidity planning, as many people did, we were getting nervous about the length of the bull run. We actually put in place some new private market pacing plans that we built custom. Tim actually came over and looked at those, or actually one of your guys came over and looked at that, Dan did, to see how that's working. So that was helpful, along with the fact that we raised some cash. We historically ran very low, about 0.5% cash. We raised that up in Q1 of last year up to 2.5. And so that paid dividends extremely well at the early part of this, because our capital calls in the first couple of weeks of this probably increased by 300 or 400% over our historical run rate on the capital calls, as many people were calling capital to pay down their liquidity lines. So probably 75% of our capital calls were to pay down the credit lines, and we had no issues trying to fund any of those because we had obviously planned for that. So
that's great. Thanks, CJ. So I want to talk about your portfolios, but since we're talking about working remotely and virtually and all the progress that you've made, being able to make decisions and collaborate remotely, can you each talk first about how you're maintaining the culture of your small teams? I imagine that being a small team, you're quite collaborative, and perhaps if you have a generalist structure, even more so. So how are you doing anything different to sort of facilitate and maintain that culture that your team has? And then maybe we could talk about diligence and how you're conducting diligence. What are some best practices when underwriting strategies, whether it's a new strategy or one that you're familiar with? How are you doing that remotely?
Okay, from a team and culture standpoint, because Texas Tech is so small, I mean, honestly, that part is not difficult. We have daily calls, group calls, every morning at 10 a.m. with the entire team, walking through what everybody's working on. We also use our systems for tasking, so I know exactly what everybody's working on. I can rearrange priorities quite easily. Second, everybody's accessible via mobile phone or desk phone. So we're constantly talking all day long regarding whatever project it is. And I think it's a lot easier to maintain that when you're talking about a group of 8 people in total and only a group of 5 people on your investment team. I think it's a different animal when you're talking CalPERS or some large institution that has to maintain culture across the board. I think where you talk about this gets tougher is when you got to go start hiring people. I mean, let's just say we stay in lockdown way longer than anybody thinks. Now you got to start, if you got to get to the point where you got to start hiring people, interviewing people, and bringing new team members on where you haven't had that joint interaction, that's going to be, I think, a whole different animal to try to build culture with new employees. I don't foresee that happening, but I think that would be a problem. The second part of your question was diligence. I think this is where the problems really hit down the road. Hopefully we get a vaccine and this isn't an issue, or some type of drug that really mitigates the impact of COVID. But if this went on, say, till next year, we'll run out of our pipeline of ideas and managers that we've already visited. And we'll be back towards, trying to find new managers to partner with. I think we have enough in the book of distressed ideas and stressed ideas to keep us busy for quite a while. But if you get to that point where you're going to hire new managers, we can do a lot of that through Zoom, but nothing's going to take the place of that face-to-face meeting where you're meeting with the ops people, where you're talking with the analyst, the PM. You can do that on the phone. But face-to-face and reading body language, it's a lot harder on video. I think that creates a problem. And I think what it does is it starts skewing you to known managers. So it's easy to go into a hedge fund book and say, I'm going to go with Balyasny or Millennium or Citadel or somebody that everybody knows, right? If you take a step down into the more niche space, you're going to have a hard time justifying going with a more niche manager if you can't visit them. So I think it probably benefits the large institutional managers at the expense of the more niche managers. The longer this goes in and the more video type diligence we do. I'll stop there and let TJ jump in.
Sure. So I think from a culture standpoint, we are a little different because we are probably the next size up from Tim. So from our standpoint, the individual teams are having daily calls between themselves and with, portfolio monitoring calls. We have several structured calls a week between different groups of people. So we have a full team meeting every Monday morning. We also have a structured call with legal, also on Mondays. I have a director's call with my team. So there's 7 or 8 of us on that one, where we're talking about getting the information spread across the different teams that, that we're getting manager information, risks, opportunities, things like that, so that we can talk about those as a group. We typically do those on Thursdays. And then I'm talking individually with lots of different people on my team with risk, operations, and either private equity or credit, talking about specific ideas and things like that. And it's interesting that Tim talked about hiring and the potential challenges there. We've actually hired 2 people and already onboarded one of those in a almost completely remote environment. We've got one person that we hired that was from the East Coast, and they're yet to start. But we actually did hire another person who was here locally from Austin, joined our team in early April. Almost all of it was done remotely, the onboarding and the orientation. They only had to spend about an hour and a half or 2 hours in the office with HR doing the actual paperwork. Everything else has been done independently, either through voice or video. And it's actually worked out better than I would have expected. And so we're actually in the final stages of hiring another person who is probably going to be joining us from outside of Austin. So we'll see how that goes. And we'll have to see about, what kind of, when are we going to have them relocate and all those kinds of things. Those decisions are yet to be made, but it does add a new wrinkle to all those conversations. But so far, it hasn't been a major hindrance for us. There's a lot of people out there, a lot of good people looking for jobs right now. So the resumes we're getting are quite impressive. So from that standpoint, it's going well if you can get through those processes. With regards to diligence, we're a lot like Tim in that we've got quite a robust pipeline. We've been doing most of our private market investing now for 4 to 6 years. So we're coming up on a lot of re-ups. And so that's going to help through this process just from the natural ability. If we end up with normally if we would have been a 60% re-up kind of a situation, maybe this leads us to be more like a 70% re-up. We're also looking at sizing up existing accounts, separate account managers. We're fortunate in that some of the things we did in our portfolio are helping us in this situation. So for example, some of our credit managers, when we hired them over the last 4 to 5 years, we actually looked for managers who were what we call toggle managers, who can do more than one thing and do it well. And so, maybe we hired a high yield / bank loan manager that can also do some stressed credit kind of stuff. And so, at the right time, they will toggle into those over time. And so it's not necessarily always about having to hire a new manager, but maybe changing there's another manager where we're looking at changing the investment guideline to broaden their opportunity set, again, so that, we don't necessarily have to hire another manager. Now, we can't do that with everybody because not everybody is multi-talented or has the diligence or, say, workout teams that you would want to have in kind of a stress-distressed kind of an opportunity set, but we have a fairly broad set of managers where we have lots of things we can take advantage of that we're doing there. But we, like Tim, we're probably, you know, good on our pipeline for another, say, 3 to 6 months. And we will be working on changing our diligence practices to try to make up for some of the less efficient things and the lack of information that we're going to be able to get, like Tim was talking about, when you don't get to sit across from them and look them in the eye, because I do think that it's very important.
Yeah, it can be challenging because this can be a really nice opportunity to upgrade the quality of your manager lineup or take, you know, advantage of new spinouts or newer funds, and it's tricky. Yeah, we've had a few lessons learned in terms of virtual due diligence at NAPC, things like, you know, taking control of the meeting, setting an agenda in advance, limiting the chunks of time that you're asking people to focus. It's actually much harder for people to do meetings in the same way, in the same time frame. Great. So you mentioned credit. It would be great to hear your views on the opportunities that are coming across people's desks in credit. I think we're all getting bombarded, first with TALF and certainly now with dislocation or opportunity funds across both privates, hedge funds, and public markets. How are you parsing through those opportunities?
TJ, you want to jump in on that one?
Sure.
I'll follow up.
Sure. So, we're trying to, we had a robust pipeline already. This is just added to the opportunity set. So we're trying to take them as they come. We've been able to take advantage of 4 or 5 different opportunities that have come across in our, let's say, credit hedge fund book. And so some of those have been a co-investment kind of an opportunity in a specific situation. Some have been a general upsize in capacity constrained managers where somebody else was forced to sell out, and we were able to come in and pick up more capacity that we had been wanting for several years. So we're looking at those. Frankly, we've looked at a couple of opportunities that came on early, and even with our increased flexibility now, we missed a couple that literally the trades, they were a good opportunity for maybe a week or 2 weeks, and there was enough capital that chased those that the opportunity closed quite quickly. And so those are interesting things, but we're also looking at, we're actually going to not be looking at a TALF opportunity fund. We're not 100% sure that's going to be a good trade longer term. We think there's a lot of good opportunity there, but we have other managers who can opportunistically get into some of the structured asset-backed type stuff we think we're going to get enough additional exposure there through several of our managers that we don't need to set up a specific program there. And try to be locked into something that was a really good one last time, and it may not be as good this time. I think generally that's one of the things that is going to be interesting this time around. During the global financial crisis, there was a lot of opportunity that was created, and a lot of people set up pools of capital to take advantage of dislocations. And thinking that, if the GFC repeated, where we're getting opportunities to buy stuff at 25, 35, 45 cents on the dollar, there's enough capital out there now that those opportunities may not hit those values anymore, at least not in substantial size, because there's a lot of money coming in off the sidelines when we're hitting 80 and 75 and 70. So you may not have those kinds of opportunities. And so we're trying to stick to our knitting, try to gain the complexity premiums that we can get longer term, and see where we can become more opportunistic and take advantage of some of those, but we're not changing most of our portfolio playbook. They're more one-off and not strategic shifts.
I think from tech standpoint, we're obviously quite a bit smaller than TJ's portfolio, so I think we can do some things that are probably nichier that he couldn't put enough assets in to move the needle. And that's kind of the advantage of the structure that we built. We built a lot of NCAs, which basically are, just think of it as a hedge fund. A private manager has a separate account next to it. So we have like over 17 relationships with separate accounts next to them that we can deploy capital into when a manager brings us an opportunity. In regard to TALF, I did TALF 1. It was phenomenal back in 09. I agree with TJ. It's not going to be as good. You've already seen spreads collapse a little bit. And the sheer volume of managers in TALF far outweighs what we saw in 09, right? It was a new program in 09. People were nervous. Not everybody did it. Now people have their ducks in a row. The capital's lined up and lots of capital. You start talking about $1 billion TALF fund, I think you're going to get an 8% return. Managers will tell you it's probably 8 to 12. I think it's at the lower end of that. And I think it's going to be a lot shorter duration than the 3-year play that people are putting funds together for. I think 18 months, you're going to get that 8 to 10 and you're going to be done. I think if you're with a smaller manager, which we are, I think you can get closer to 15% because you're going to step out a little bit on the asset back side and go to the little bit more esoteric and a little bit harder to define asset backs to slide in there that have less liquidity and less volume to buy. So the little $100 million TALF funds or $200 million TALF funds, I think will greatly exceed the large brethren that are $1 billion. We did that through a co-invest with one of our existing managers to put TALF money out, and we've already made that commitment during the crisis, and we're just waiting to ramp that up once everything's green lighted. As far as other opportunities in credit, we're seeing quite a bit through our co-investment pipeline, which is what we expected to see. And a lot of it is nichier. I think to TJ's point, middle market off the run loans look pretty phenomenal here. You can find, the problem is that it's not super liquid, but if you already have a manager that can go in and cherry pick certain loans and pick them up, you can get above 15% returns in that paper and what you think are really sound companies that will make it through COVID. That to me, on a risk adjusted basis, looks better than the levered TALF trade of the large funds. So I think that's a place that's ripe for picking and still doesn't have the liquidity in it that you would expect right yet. CLOs, we have an empty CLO bucket, kind of similar to what TJ was talking about, a trigger fund, right? I don't think we'd ever really called it a trigger fund, but we just had a separate account waiting for a dislocation. Lo and behold, here's the dislocation, right? We still don't have anything in there, but we're talking with that manager about what is the right time to go in and start picking off some CLO paper, CLO equity, triple Bs, whatever the case may be. And then our asset-backed managers have lots of opportunities flowing through right now that we think look very, very sound. So we'll be adding to those. I'll stop there, but those are just 3 opportunities that we're seeing that look attractive.
Yeah, I think that the other thing that I've seen that we've looked at, we haven't done a whole lot in the IG public space opportunity set that's been around. We've done a little bit of that with some of our managers, but you know that went away pretty quickly in a good sense in the major dislocation. So there's still some opportunities there, but it's less interesting than it was, and I think right now it's too early for the private credit opportunities to come more in mass. There are interesting one-off opportunities, but again, I think size is not there yet in the distressed kind of trades yet. I'm thinking that's more of the second half of this year or so.
Yep.
Great. And how are you thinking about GPs that are maybe dipping their toes into areas where they hadn't been before? And what I mean by that is, you know, maybe a hedge fund manager creating a drawdown vehicle. Are you interested in those types of strategies? Do you feel like they understand the way to set the terms and to run those types of strategies? Or are you kind of sticking with the managers that you already have?
Well, my standpoint is, Sarah, I recommend those to my other endowment brethren that I'm compared to in an endowment universe, and highly recommend that they do that.
Yeah.
In all seriousness, I think you got to be very careful with that. Guys that trade around hedge funds and stuff aren't necessarily private guys in a drawdown fund. So there's a lot of red flags that go up there. So there are quite a few hurdles to go through to get comfortable with a hedge fund manager that all of a sudden wants to start doing a drawdown fund. If they're doing the drawdown fund as a simple way to protect liquidity and runs on liquidity to give them time to implement a very similar strategy that they're running in the hedge fund, that's just now a liquidity consideration, then I think you can maybe get comfortable with it. But if it's like a new strategy, say they're a merger arb guy and now they're going to do lending, run.
Yeah, and I think Tim's got a great point there. And so we have been looking, as many people have been, looking at longer lockup vehicles with certain managers, where a hedge fund may have typically had maybe a one year limitation of liquidity, and we've been trading off liquidity for fees quite actively for several years. And so that's we've got some managers that have done that very well. We have other managers that have wanted to do that we've not been comfortable with. So I think it's very manager specific. What is their investment style? What's the reason that they're trying to do this kind of fund? So we have been doing that. We do look at those, and we have taken advantage of a couple of those where it's been right, and we've also declined on other ones where we just don't feel like the tenor meets the needs of or the skills of the manager.
Yeah. Okay, great. So I'm going to try to weave in a couple questions that we're seeing from the audience here. One question is the degree attendee asking about the degree to which LPs such as yourselves are collaborating with one another and sharing ideas. TJ, you alluded to earlier, a member of Tim's team coming over, and it's clear that you guys have a great relationship. Can you talk about the landscape and how folks are working together or not in the LP space?
Sure. So we actually, Austin is actually, I feel very lucky. Austin is probably the best investment community I've been in. I've been in lots of different places through my career, but working with Tim, working with teachers, working with Tom Tull at ERS, we have constant communication. Tim and I actually attend a lunch of other CIOs here in Austin probably every 6 weeks or so. And so we share a lot of ideas there. It's just the CIOs. It's not other people. But I've also had, reach out to senior staff at other funds. So Dan on Tim's team, we talk with him quite frequently. So talking with senior people at ERS and TRS as well, Permanent School Fund. So there is a lot of collaborating, and people will pick up the phone when you call them. Even if they see it's Tim Barrett calling, they still pick up. But it has been good. And I'm actually starting to have conversations now about how can we try to leverage other people's due diligence processes on managers we may not be able to visit in person. But maybe Tim has been to their office 10 times. And so can we look at ways to leverage those kinds of opportunities in our due diligence process to help get us access to managers that we think might be interesting, but we're restricted from traveling to?
Yeah, I would echo TJ's comments about Austin in general. It's a phenomenal investor-friendly environment here. The only thing I would probably add to that is that over the years, since I'm getting older, I just know a lot of people in the industry that are CIOs at other places, and you tend to, over time, because your style tends to be a certain way, you start getting pretty close to other CIOs who think like you do, and they're looking at the same style of investments or same type of investments. So we've really created a small, unique group of, I'd probably say, another 7 CIOs that talk rather it's infrequently, but I'd say quarterly to twice a year. We'll be on the phone with another group that's investing in something similar that we've done, or I'm investing in something they've done, and we're just picking each other's brain about how that has gone, how the negotiation went, and are they happy with the results that they've garnered so far. And we find that super helpful.
And I would add just one other wrinkle to that is that, in Austin, we have probably 10 extremely large investment groups, which would include Texas Treasury and UTIMCO. And so we communicate with them as well. And so we actually get to talk about a lot of things that are maybe appropriate for Tim's size portfolio, but we can't get a hold of, or things that maybe UTIMCO's doing that Texas Tech can't do, or needs to do in a different way. And so it's not just public pension plans or endowments or foundations. There's a good broad mix here, and we all talk to each other. In fact, I've got a call with Texas Treasury on Friday this week just to do a quick catch up with one of their senior people, and I had a call with their CIO last week. So there's a lot of communication going on at lots of different levels.
That's great. That's great to hear. Yeah, that was my experience when I was in your shoes as well. So a couple of questions from the audience about your portfolios and this particular market sell-off. The first part of the question is, were there any managers that gave you a warning sign that this type of environment might be coming? And the second part of the question is, in those really scary times in March when we were having 10% moves, how did you behave? What changes did you make to your portfolio, if any?
I guess from my standpoint, I've kind of been through a lot of this pain before. I would say that this one was more rapid than usual, a lot more rapid than 08, and a lot more pain quickly. As far as how we behaved and what we did, we run a levered portfolio, so we have derivatives, and we ran into liquidity issues. So we started raising liquidity from pre-planned sources that we had. That's never fun in a downturn and hurts your performance a little bit in the downturn. We believe over the cycle that levered portfolio will outperform, but in a downturn you give some up. So I think that probably hurt us a little bit, reaching for some liquidity in that environment. I would say, as far as managers that give me a pre-warning that it was coming, that's relatively non-existent for me. I have certain managers that are always defensive. I got some credit managers that have hated the market for a long time, right? They've talked about liquidity in credit markets, the fact there's no B in the broker dealer anymore, that there's going to be a bloodbath soon, etc. That the Fed's backstopping everything. That talk's been going on since 2010, and it continues. So I wouldn't say that we got any massive warnings from any manager. I wish they would have picked up the phone call and say, "Hey, Tim, go 100% short." Didn't get the call.
Yeah, and I would probably echo that. In fact, I would probably be even a little stronger in that, we were probably more cautious, and in 2019, not because we knew COVID was coming, but it just, lots of things seem to be what I call incrementalized, where it's like, well, you did something in 2015, and then in 2016, you reached a little more, and then 2017 you reached a little more, and it seemed like everybody was talking about how to improve the portfolio a little bit, and so it wasn't making a lot of sense to us to reach for each of those. And kind of as every year kept going, it seemed to make less and less sense to us to reach for that slight bit of extra return. So we became more conservative, and managers were at some points getting frustrated with us because we were like, that's actually not that much better. And it's pretty asymmetric in that if we do it and it works, okay, great, we make a little more. But if something changes, we get smacked pretty hard. So we didn't do a lot of those. And so we didn't get a lot of heads up. And in the March behavior, you know, we really kind of stuck to our knitting. Because we were already reducing our public equity allocation, we had made a strategic decision back in December to take our public equity from 35 to 30. And we were in the process of implementing that in the first quarter. We got down to about halfway, down to about 32.5% through rebalancing and trimming of some managers. And then the markets helped us finish that. We got down to about 28.5% at the depth of the drawdown, and actually started looking at reinvesting, rebalancing into that part of the market. But frankly, the market turned around so fast. We were back up above 30 within like a week and a half. So we didn't actually get to hit that bottom rebalance. And since that point, we've actually been taking off all of the gains. So every time we get back over 30, you know, we take it off the table. So I took some money off the table on Monday. I took some money off the table last Monday, took it off the table 2 weeks before that. So right now we don't think we're going to get paid to be overweight public equities right now. And so we just keep trimming that to keep us at that 30. So we've just been rebalancing a lot more. We think the risk to the downside is bigger at this point, that we're less willing to keep the overweight.
Yeah. Right.
We were very similar, DJ, because of derivatives, we were overweight through fourth quarter last year, which was a great quarter, as you remember. And we went in overweight in the beginning of the year. And as the market started falling, we started shutting down derivatives, taking beta off. So we got down to about 25, a little below 25. But we didn't really re-risk either into the run. We just used that as taking the cash flow off the derivatives to increase our cash position back up. We're sitting probably at about 27% right now in equities. And we'll probably maintain there, because the way I look at the market right now, you kind of got to, on the S&P, it's 3,000 to 2,700 is kind of your range. And to me, right now, we're range bound until we blow through that 3,000. So you can almost just kind of trade that range, and that's how we're thinking about kind of the U.S. equity market per se. Europe, we think, is a train wreck. That's not super attractive. If I was overweight, and I'd be overweight in Japan over Europe right now.
Yeah, when we're trimming on the public equity side, we're taking all of the exposure off of our non-U.S. portfolio. We just think that, as Tim said, that's a much bigger risk at this point in our mind. So when we are trimming, we're not taking it equally from our global portfolio. We're trimming our non-U.S. side.
Yeah, the thing I found fascinating today, and I know that you didn't ask this question, but I mean, when I was looking at the markets over the last few days, is how much hope people put in the vaccination. I understand that hope, but it was very clear in all the media outlets of what came out that study was based on, like a handful of people, meaning it had no efficacy. Yet the market popped up 3% on hope. And I understand hope. Everybody wants hope. But you also hope that markets are rational. My fear on the downside of that is, should something go wrong with that process, I think that the downside of this can be just as violent as that 3% upside swing. So I think you're going to maintain that volatile range right now.
Right.
And then you couple election period coming in. And I don't know how you guys think about this, but my view is that you can see it in Trump's language already, that we're starting to amplify trade war discussions internally as a campaign rhetoric. I think that's going to have impact. I think we're already in the war with China. People don't want to admit it, but that trade war is, I think, coming. It's going to be hard to stop. If you just look at everything the federal government's doing, stopping investment in government programs, putting more restrictions on Chinese tech companies, etc. All of that is just slowly burning in the background and churning. It's going to create another volatility event. Hopefully not during the pandemic crisis, because I don't think we need to. But you can see that, the next volatility regime is right around the corner.
Yeah, and so Tim, thank you for that. It's right where I was going, which is thinking about where the markets are today. Does that feel rational, given that we have easily well into double-digit unemployment numbers? We're going to have GDP numbers and earnings numbers come out that are very disappointing. We talked about real estate investments not paying their rent, yet the equity markets have almost fully rebounded. TJ, it looks like you might have a crystal ball behind you in your desk there. If you were to think, forward over the next 12 months, do you think we're, what the markets are pricing is reasonable, or do you think we're going to have another large dip down?
My bias is that the markets are way ahead of where we should be at this point in the rebound. I think if I have to lay money on it, we're going to have another pullback, which is one of the reasons what I've been doing as I've been trimming that public equity is I'm just building more cash in preparation for that. And, I've got two opportunities for that. Either we're going to have good credit opportunities in the private market space going forward, which are better than what our earnings are right now, even if it's not huge kind of distressed kind of returns, we're still going to get better returns than we've got today in the credits, or we would have good opportunity to take on some more equity after a pullback. So I think cash is a good thing to have right now. So we have a little more than we usually do. We're probably up to like 5%, like I said, 5.5%. But I think that the equity markets are running way too far ahead of the economics. And I think as you said, when the reality hits, and my best guess is we're going to extend unemployment benefits. That's going to be a negative. Even in Texas here, we're reopening, and you're starting to get these conversations about are we going to get a resurgence of COVID? Mm-hmm. And I don't understand how you cannot think we're going to get a resurgence if you reopen, because you're going to have more interaction. The numbers are going to go up. The question is does it go up, and is it still a manageable number, or does it spike to an unmanageable number? I think that's the difference. But it really is interesting how many people seem to have a narrative out there that we're going to reopen, but we're not going to have an increased number of COVID infections. I just don't think that's reasonable. And so I think given unemployment, given the GDP numbers that are going to come out, they're going to be terrible. I have to believe that people are going to have a more negative reaction to that in the future than they're having right
now. Yeah. So maybe we have 3 minutes left, maybe one more question for you. I think this rapid rebound has sort of cured a lot of problems for CIOs and pools of assets, and taking care of a lot of issues. What's your biggest concern? I know one of the things that I always grappled with, my biggest fear, was a prolonged period of, rather than having a rapid recovery, having a very slow, shallow one. Have you thought about how that might impact, your organizations and how you do what you do?
About if it's a long, shallow recovery.
Yeah.
I think that's the likely scenario is a much longer, slower recovery. So we actually think that that's probably what will occur. I don't think the economy is going to get right back to work. You're seeing restaurants at 25% capacity. Most restaurants can't even make it at 25% capacity, by the way. Most of them will go bankrupt. So I think it's going to be a lot longer and harder than people think on the service economy. And I think the way we're positioned now, being fairly low in our equity allocation at 30%, we're in really good shape. In that environment, in a slow recovery, it's called cherry picking good credit and cherry picking good equity. So you're going to want active equity guys you're going to want active credit guys, and you're going to maintain your kind of allocation discipline. I think the other places you want to do is start adding the macro, because there's going to be massive currency and inflation related issues down the road when you just think about every single central bank in the world has printed money left and right, barring China, I would say. But you're having a lot, and then you throw in the trade war, just, you know, what's going to go on with the Hong Kong situation, the Taiwan situation. I think you're talking about a lot of volatility and macro themes, and I think that's how you take advantage of it. You know, for us, it's pretty status quo to where we are. I think the one thing that we'll probably consider is aligning ourselves more in that macro camp going forward a little bit. Will probably be a high priority.
And I would say from our standpoint, you know, it's interesting because it's one of the things that a lot of people don't take into consideration, and that our actuarial discount rate is 675, as I said in the beginning. And if you think about the opportunity set that's out there right now, we really have an opportunity where we were going to be stretching a little bit from a credit standpoint to try to help us hit that 675 blended rate. Once you think about what equity is going to be delivering, I actually think that this is going to be helpful for us to hit that 675 number, given our preference for different kinds of credit strategies, and the fact that we don't have to reach for 12%, 15% kind of returns on credit that are probably going to be available. We can still stick in the 7 to 10% kind of credit returns, opportunities, and still hit our numbers. And so I think that structurally is very helpful for us. And it's one of those long-term strategic planning things that helps us get through these kinds of times without having to reach for extra returns.
Geez, that TALF fund sounds like it fits your profile.
It might. I don't want to. I think it's not a good trade-off for staff time to take advantage of that. I think we've got much better opportunities that'll last longer, pay better dividends.
Yeah, I think you're right.
TJ and Tim, thank you so much. I think we're just about out of time. This was fantastic. And best of luck to you and everybody on the line as we navigate the future from here.
Really appreciate it, TJ.
Thank you.
Sarah, thank you. And appreciate you, Austin and Diligence Vault. Thanks for having us.
Thanks for having us on.
Thanks a lot.
Yeah, thank you guys. And thank you all to the participants. Bye-bye. We will be following up with an email with any information. If we missed any questions and answers, we'll try to get to some of those. And everybody have a great afternoon. Thanks, Tim, TJ, and Sarah.
Thank you.